I am the executive chairman of MicroStrategy. We're the world's largest public holder of Bitcoin. We're an operating company, a software company. We do business everywhere in the world. The year 2020, we had a very stable $500 million revenue operation, generating about $75 million a year in cash flow. We had a stable cash cow business and loyal customers, but our stock wasn't interesting to the capital markets. So we started thinking about a way out. We thought, well, maybe we can buy something that's high growth, but it's very difficult to find a high growth digital monopoly. And so as we were looking around, we discovered Bitcoin. And we thought, if we bought some Bitcoin, that's the same as buying a high growth digital monopoly, and maybe we can transform our business. And the short of it is, over 4 years, from 2020 to 2024, the MicroStrategy story is we raised about $7 billion of capital via equity and debt. We bought, all told, about $7.5 billion of Bitcoin. That has nearly doubled at this point. The company's market cap 20x, and the company's enterprise value 40x. The company has approximately $14 billion worth of Bitcoin. The existing software business is still a $500 million business, generating about $75 million in cash flow. But in essence, the MicroStrategy story is one of digital transformation, where we recapitalized the company with digital capital. And what's interesting is, at this point, there are thousands and thousands of companies around the world that could also recapitalize with digital capital. And of course, the problem we faced, low growth, steady earning business that's being rapidly marginalized by megacorps, or a big cash treasury, which is being diminished by inflation. That problem is faced by every person on earth, every institution, every family, every private company, every public company, and every institutional investor has to consider it. And so that's, I think, what leads me from where we were to here. You can recapitalize your company with it, or you can build products and services based on it. So one of them is a balance sheet strategy, and the other is a P&L strategy. But I'm going to focus upon the balance sheet strategy because I think it's the more powerful one for now. The world's treasury reserve asset, for the most part, for operating companies, is the T-bill. It is debt, generally sovereign debt, oftentimes US sovereign debt. So if you have an operating company and you have an extra $100 million, conventional finance suggests you either give it back to the shareholders in a dividend, and if you do that, you get double taxed on it, or you buy the stock back, you do a big share buyback. Apple's just announced a $100 billion share buyback. Meta announced a $55 billion share buyback. And that's another way of giving the capital back to the shareholders. And the third thing you could do with it conventionally is you would buy $100 million of T-bills, and maybe you're generating 5.5% interest right now, but that gets taxed. And so after tax, you generate about a 300 basis point yield. The problem with the first strategy is you get double taxed and you don't have the capital. The problem with the second strategy is you get single tax, not double tax. So it's not as bad, but you don't have the capital. And the problem with the third strategy is you have the capital, but the cost of capital is about 12% a year. The cost of capital could best be estimated by looking at the average return of the S&P index and then adding a risk factor on top. So over 100 years, the average return of the S&P index is 7%. The risk factor is 5%. Right now, the return of the S&P is 12%. So therefore, the risk factor should be a bit higher. So, I mean, you could even argue the cost of capital right now is 16%. So if I invest the money at 3%, the cost of capital is 16%, that's a minus, 13% real yield. If the cost of capital is 12 and I'm investing at 3, it's minus 9% real yield. So invest $100 million in T-bills, you're burning something like $9 to $12 million a year of shareholder value. that's the number one problem every corporation faces, all the way from Apple Computer, Google, Meta, Microsoft, all the way on down to, a small restaurant, a $1 million a year business. They all have the same exact problem. Private companies or institutional investors or families, they know this is silly. So you will never meet a billionaire that brags, I made $1 billion by buying government debt, right? And they will never brag, I made $1 billion by putting my money in the savings account in the bank to earn 3% or 4% interest. They know they have to invest in property, or they have to invest in equity or alternative assets. Private investors don't have this problem, but the problem with public companies and public investors, especially public companies, is the rules around operating companies prohibit you from investing more than 40% of your treasury in securities. It turns out that typically government bonds are securities, but there's a waiver. There's an exemption for government bonds. So the law counts treasury bills as actually not securities. This is why, for example, Berkshire Hathaway has $180 billion of treasuries, or $190 billion in treasuries, and they don't just roll that money into the S&P index. So what is the power of Bitcoin? Well, Bitcoin isn't a security. Bitcoin is a commodity. It's property. So if I give you a treasury with $1 billion, you can buy $1 billion of debt that yields 3% after tax, or you can buy $1 billion of Bitcoin. But the real key is you just need something that will appreciate faster than the S&P 500 index. And you'll probably beat the cost of capital and not underperform the cost of capital. So really, the Bitcoin strategy that is most compelling right now is recapitalize your company by sweeping your cash flows into Bitcoin or raising debt. Look at what happened to MicroStrategy. We had $2 million a day of stock trading, and we had very low volatility. When we started buying Bitcoin, our equity trading every day skyrocketed. Today, we have something like $2 billion a day of equity trading. Our volatility went to 100. It went to more than 5 times, 7 or 8 times the S&P index. When your volatility goes up, if it goes above 45 or 50, then you can actually issue convertible bonds because the warrants or the options associated with the convertible bond becomes very valuable. So we're able, in the last quarter, we raised $1.4 billion of capital, non-recourse unsecured debt, 6.5 years average term. Average cost was 70 basis points, 0.7% interest. The average cost of capital, if you wanted to raise money as a normal corporation, you would pay 8 to 10% interest, and it would be secured maybe by your cash flows with lots of covenants. We're able to raise unsecured, no recourse debt, no covenants. The cost of the money is effectively zero. Now, why? The reason why is primarily because we have such high liquidity and high volatility in our equity trading in the market. Of course, conventional finance wisdom is I want to strip the volatility away from the P&L. I'm going to actually create a company where the cash flows and the revenue are predictable for the next 3 years. That's what Microsoft does. They could predict the quarterly results a year from now because all of their customers have signed 3-year enterprise agreements with built-in escalators. And so they think that's good. There's no uncertainty. But if there's no volatility on the P&L, then the options are worthless. And then what they do is they take the volatility out of the balance sheet. If you don't have any assets on the balance sheet that are volatile, like right now, Bitcoin is up $1,400 since yesterday. So that means on the weekend, the volatility was quite high. That $1,500 works out to about $300 or $350 million of benefit to MicroStrategy shareholders. That's 5 years, maybe 6 years of operating income. So we had 6 years of complete volatility. It's like we told the market we were going to double our earnings for the next 6 years. Between yesterday at 8 p.m. and this morning, we basically gave them a massive upside surprise. So that will cause the stock to trade today. And that's very good for the option holders. If tomorrow it moves down the other way, it'll be 5 years of no earnings, massive volatility. But the result of that is a company that was uninteresting. The enterprise value of the company was 600 million. Today, the enterprise value is 25 billion. The open interest in our options is $26 billion. The stock will trade more than 10 billion this week. So the company has become interesting. The options have become valuable. Liquidity has come back to the marketplace. This has attracted the convertible arbitrageurs and the fixed income investors. So if you're a company and you embrace a Bitcoin standard, what that means is you can accumulate huge amounts of capital. You can put value back into your stock options for your employees. You can put options in the market for the arbitrageurs. You can raise capital plentifully, quickly, and cheaply. We raised $1.4 billion in about 8 days for free, no strings attached. So that's the promise of Bitcoin. You know, this is coming out of the blue. You're saying, how come no one's ever told me this? It seems like such an obvious thing. Well, before January of 2024, the accounting standards for Bitcoin were indefinite and tangible, which meant that if you were to do what I've described, you could only write down the Bitcoin. You could never write up the Bitcoin. And that would be toxic to your P&L and your balance sheet. So no conventional CFO would want to embrace this strategy under indefinite and tangible accounting. But it was only in the first quarter of 2024 that you could adopt fair value accounting. And fair value accounting now allows you to separate your investment gains and losses on your balance sheet from your operating gains and losses on your P&L. So there's a very important regulatory adoption of Bitcoin in the accounting community. And the second thing that happened this year is that the SEC in the United States approved 11 spot Bitcoin ETFs. And when the SEC approved them, they signal to the market that Bitcoin is commodity. It is an institutional grade asset, and they will allow tens of billions and then hundreds of billions and potentially trillions of dollars of capital to flow into the Bitcoin ecosystem. And it is now an institutional grade asset that a publicly traded company can hold. Yeah, the ETF adoption has been good for us. There are about 22 spot ETFs in the world. There are more derivative ETFs to trade options and the like, but there are 22 ETFs we've counted where you can buy the security and they will turn around and buy spot Bitcoin ETF and hold it. They're all one-for-one unlevered investment vehicles. They're all SEC 40 companies. They're investment trusts. And what that means is if you give them $1 million of cash, they can buy 1 million of Bitcoin. If the Bitcoin is cut in half, you'll have half as much as you had before. If it doubles, you'll have twice as much. They'll charge you a fee, small fee. MicroStrategy is a different kind of company. MicroStrategy is an operating company. Tesla, Block, all the Bitcoin miners are operating companies. The thing that's special about operating companies is operating companies can issue equity per shelf registration to raise permanent capital, which they can invest and take risk with, risk capital. And they can issue fixed income instruments and they can issue convertible debt instruments. So operating companies can issue other kinds of securities other than just a simple ETF certificate or ETF share. So for example, what MicroStrategy is doing is we have borrowed $3 billion via convertible debt, and the blended cost of the convertible debt is about 50 basis points. So we pay about $15 million a year to have $3 billion of capital, which when we have been investing in Bitcoin, and if Bitcoin's going up 40% a year, we can take the risk of borrowing money for 50 basis points and investing in it for 40% interest. And then we capture the difference for our shareholders, right? If you think about an ETF as like container ship or freighter, they've got huge cargo. They kind of go slow, but they can carry, you could invest $100 billion in an ETF tomorrow, and then you would basically be getting that exposure, low cost, 1-to-1. If you tried to buy $100 billion of MicroStrategy stock tomorrow, the capital structure isn't that rich or isn't that big. So you would create a premium and you would drive that premium in the stock, and you wouldn't be able to buy it at net asset value. But that inefficiency, that premium that we generate, we're able to monetize for our shareholders, because if you drive up our premium, we can issue convertible debt at a premium to the premium, and we can then recycle that or arbitrage that back into Bitcoin. And so the equity holders get the benefit of the double arbitrage. And if you drive a premium in the equity, we can just sell the equity, buy Bitcoin, and capture the single arbitrage. And so MicroStrategy is really securitizing Bitcoin. The ETFs are simply enabling massive one-for-one investments. They benefit from our activity because we're locking up, probably there's $15 billion of Bitcoin directly locked up. But there are a lot of people that short MicroStrategy stock to buy Bitcoin. Say you short $1 billion of MicroStrategy at a premium, and then you buy the underlying $1 billion of Bitcoin to capture the arbitrage. You're helping Bitcoin, and you're helping the spot ETFs, and you're also driving more demand for Bitcoin. And, we don't really mind, because you're actually creating more liquidity and more trading in MicroStrategy, which benefits us long-term too. So there's a very sophisticated ecosystem of public companies that are all securitizing Bitcoin as an asset class. It's a mutually beneficial engagement for everybody. So I think the way to think about Bitcoin is the greatest city in cyberspace. And it's a city in cyberspace that is 276 blocks across, 276 blocks high, and 276 blocks deep. There will never be more than 21 million Bitcoin. The cube root of 21 million is 276 to the nearest integer. So we have bought 214,400 of those blocks. It's like buying acres of Manhattan. Right? If you knew there was a city on an island that was the crossroads of commerce for everybody in the world, where all of the capitalists would either want to live there or they'd want to move their capital through that city, and you could never make any more of that land, then you might want to buy that up. And the New York trade, buying Manhattan's been a good trade for 300 years. And so you could think of us as a real estate development company in cyberspace. We call ourselves a Bitcoin development company. We have progressively acquired more Bitcoin every single transaction. We will keep acquiring Bitcoin. Our primary way that we create shareholder value is we issue securities at a premium to the underlying commodity, and then we buy Bitcoin with it. Now, some people might think, well, that seems kind of dangerous to issue securities to buy a commodity. And the truth is, it would be if it was any other commodity in the world other than Bitcoin. It's a bad idea with silver. It's a bad idea with soybeans or oil. It's a bad idea with gold. It's a bad idea with natural gas. You wouldn't want to buy the commodity directly, because commodities don't hold their value. Human ingenuity and capital keep finding ways to create more commodities more cheaply. Over a short period of time, it's not always obvious, but over 100 years, if you think about it, and I said, well, do you think it's cheaper to drill for oil today or 100 years ago? Or are we better at it? Are we better at growing food? Are we better at creating soybeans now than 100 years ago? Well, we're generally better at most things. Computers and machines and capital, and experience have made us better. The difference between Bitcoin and a commodity is Bitcoin is capped at 21 million. It's the world's first scarcity. And so any physical commodity is unlimited. The supply is going to expand as the price expands. And so there's elasticity. Bitcoin isn't physical, though. It's digital, and it's not inevitable that a digital commodity would be scarce. It just happens that the way that Satoshi designed the protocol made it scarce. And so Bitcoin is a perfectly designed monetary protocol for scarcity, and it was designed to never be more than 21 million. And because it's capped out, Satoshi didn't just create the first digital commodity. Satoshi created the first digital scarcity, which is the same as the first scarcity in the entire world. The closest thing to that would be if every rich person in the world agreed they all wanted to own Picassos, and Picasso was dead, and there were only X thousand Picassos, and there were no more Picassos, and we agreed that all of us were going to store all of our wealth in Picassos, then that might be something similar. It might be a scarcity. And that's why you see collectibles, like Leonardo da Vinci paintings or the Magna Carta. That's why those things that are universally desirable are so valuable. But the next closest thing is just land in the middle of London or Paris or New York. But the square footage on top of the land is less valuable. And ultimately, you can build more land and you can build more buildings than square footage. So those things have a bit of elasticity in them. What Bitcoin represents is something completely inelastic to price. And so when you ask, what is MicroStrategy's strategy? Well, our strategy is just keep buying Cyber Manhattan, because one day all of the 8 billion people in the world will be trading digitally, and they'll want to put their capital in this one place. And there's only ever going to be 21 million blocks or less of it. So it's something where, you can buy it and hold it 100 years, and you just know it's going to go up faster in value than the S&P index or any other investment asset like a building or a piece of land in Manhattan. If we go back to the monetary theory, let's talk about the base of all of this. What is money? Money is economic energy. If you have wealth, if you have $1 billion and you want to store your wealth or your economic energy for 100 years, you have to figure out what asset you're going to trade it into. And there are all sorts of assets. If you think hard about it and think about frequency, when you're moving money at high frequency, like every day to buy coffee or to pay your bills, that's normally a currency. And you need a currency asset like the yen or the dollar or the euro or the peso. And when you're actually using your economic energy at low frequency, you're going to hold it for a decade or for 30 years. You don't store your 30-year money in the peso or the euro or the dollar. You would buy a building with it, or you would buy a sports team with it, or you would buy a stock with it, or you might buy some artwork with it, or you might buy natural gas rights. You would buy something different that you think will hold its value more than the peso or the yen or the dollar. So money, it divides into two classes of asset: the currency assets and then the capital asset. And I think the capital asset is long-term money, low-frequency money. The currency asset is short-term, high-frequency money. Now, MicroStrategy wanted to find that capital asset, and we thought about buying buildings, and we thought about buying artwork, and we thought about buying Apple stock or the S&P index. And what we realized is the ideal capital asset is crypto property. If I could create a city in cyberspace, but you couldn't make any more land in the city, and there was no property tax and no mayor, that's better than Manhattan. Because Manhattan's not valuable to people in China or Japan. Manhattan appeals to a part of the world. But what if I created a cyber Manhattan that appealed to everybody, no matter what language they spoke, no matter what flavor their money, everywhere? It struck me that a crypto property is better than physical property. And then I started thinking about gold, and it struck me that crypto gold is better than physical gold. Because if God came down from heaven and said, you can't make any more gold, there's only going to be 21 million gold coins, I'm going to let you teleport the gold, telepathically move it. I'm going to let you program the gold. I'm going to let you hold it in your head. I'm going to store it safely in heaven forever for you. And I'm going to make sure that no one ever steals it from you. And I'll do that all for free. You would think that's a better gold. But of course, God's not doing that. And so we create a crypto gold that does that. So your first observation is, wow, Bitcoin or crypto gold and crypto property look like better investments than physical gold and physical property. So the next question is, well, I heard there's 10,000 different cryptos. They all claim to be better than Bitcoin. Bitcoin's the first, but everybody thinks they're the next Bitcoin. They're the better one. The question becomes, well, which one's the best? And in order to find the best one, you have to answer a set of questions like what's most ethically sound? Which one is most technically sound? Which one is most economically sound? Okay, well, the ethically sound question comes down to, did a group of criminals create the crypto? That's not good. Did a company create the crypto? That's a little bit better, but it's still not good. Or did the people create the crypto? Is it of the people? Is it common property? Or is it corporate? Or is it criminal or counterfeit? Well, what makes Bitcoin special is the immaculate conception. Satoshi created this network, created a way, then he gave it away, then he walked away, right? A very simple thought. If someone created something, gave it to the world, never benefited from it, and left, that is the definition of common property. So Bitcoin was made a common property through the behavior of Satoshi. Satoshi mined 1 million coins. They've never moved. They will never move. The whole point was, look, I give this as a gift to the world. This is yours. This is not mine. There is no company behind Bitcoin. It is common property. All the other cryptos have corporations or criminals behind them, right? And the big ones, the top 100, have corporations behind them. And you can see them, you know, whether it's the Ethereum Foundation or Consensus, or I could go down the list, the Solana Corporation. If there's a CEO, right, and if you can subpoena it, right, then it is corporation. It's corporate coin. And they own a lot of the coin. They had pre-mines, they had ICOs. They're really just like securities. And because they never came public, they're probably unregistered securities. So the corporate coins, they don't work as global money because there's a company behind it. And then, of course, the coins launched by the criminals, you know, like the Terra Luna, you know, or FTT token are two examples where the people that created them are in jail now. Well, that's kind of a silly idea, right? It makes no sense for you to trust your life savings in a criminal coin or a corporate coin. So Bitcoin represents the greatest common property in the world. And, you know, how do you know it's the greatest? Well, it's not just the fact that Satoshi launched it with an immaculate conception. The second way you know it's the greatest is that it has the most powerful computer network backing it. It has somewhere between 20 and $40 billion of capital invested in Bitcoin mining equipment. And these are custom silicon ASICs that are generating about 600 exahash of computer power every second. That is more power than all of Amazon or all of Microsoft or all of Google's data centers. So it's the most powerful computer network in the world for protecting your property. The third thing that it has behind it is the most electrical energy. So it's a very decentralized network of digital power. The fourth thing it has is it has hundreds of thousands of node holders. And they've got Bitcoin nodes and they're running them everywhere in the world. And they're using that to independently validate the network and keep track of every transaction. So it's the most decentralized of the networks. The next thing it has is 200 million plus holders who have invested collectively something around $700 billion or more of real capital. Remember the story of MicroStrategy? We put $7.5 billion into the network in order to get 1%. Well, if you actually look at the 200-week simple moving average, or you look at all the trading patterns, or you look at MicroStrategy and scale up, you can divine that someone took about $700 billion of real money and invested it in Bitcoin. Now, what's the most amount of real money that's been invested in the second best thing? Not even 1% of that. I'll say it again, not even 1% of that. So all of the smart money in the world looking for the world's greatest crypto property or the world's greatest digital capital network, all of the smart money has picked Bitcoin. You know, what does the stupid money do? The stupid money gambles, and that's okay if you're drunk or if you're having fun for the weekend. And if you want to gamble, you can do that. But if you're actually thinking to invest your capital for your family 30 years from now, to save your corporation, to save your country, to save your family, to save your institution, you don't gamble away your treasury in Vegas, you know, or Macau, right? When I say there's no second best, Bitcoin's got the most economically sound protocol. It's the thing least likely to be corrupted, debased, inflated away. It's got the most technically sound protocol. It's never been hacked. It's the least likely thing that you could own to be hacked. And why is that important? Because if it's not ethical, the regulators will designate it an unregistered security or a criminal enterprise, and they'll shut it down. And that's what's happening right now. The reason that there are 22 spot Bitcoin ETFs is because the regulators deem Bitcoin to be the ethical commodity, the superior commodity. The reason that there won't be any other ETFs is because they're not going to allow you to wrap a corporate property or a criminal property into an institutional security wrapper, right? I mean, their job is to protect the investors. So you're not going to allow that to happen. So if you're actually trying to pick the winner, there is a winner. When you're investing in digital devices, you better pick Apple. When you're investing in digital information or digital search, you better pick Google. When you're investing in digital relationships, you better pick Meta. When you're investing in corporate digital processes, you better pick Microsoft. And that's because there is one digital winner. Everybody else gets ground into the dirt. And Bitcoin is digital capital. It is the winner of the network. It's now possible to see it. There isn't a second best. I think it is. You could think of Bitcoin as a bank in cyberspace, or you could think of it as global property. So if I had $1 billion, let's take a simple example. I drop you in Africa, and I give you $1 billion. And I tell you, you can buy anything in Africa, but you have to keep it there for 100 years. Or you could buy Bitcoin. What do you want to buy in Africa with your $1 billion that you feel safe to own? If you're Taiwanese, like what country is secure and stable in Africa? The truth is, you would say, well, I don't know if the political regime is going to be stable for 100 years. I don't know if they'll ever show up and decide to seize the property, my building, my land, my ranch, my company. So if you think of it like that, you would say, there's really nothing that I want to buy anywhere on the continent. And there's no country I want to invest it in anywhere in the continent that is safer than buying $1 billion of Bitcoin, because Bitcoin could be self-custody. Bitcoin can be put in a bank in Singapore, Switzerland, New York, Paris. Bitcoin is a $1 billion building that can be teleported every day to the safe place. If I need to leave the country, I can take the Bitcoin with me in my head. I can teleport it out of the country. I can't carry the building. I can't take $1 billion of gold. I can't take the company. I can't take a semiconductor facility. So if we generalize it and we just say, well, here's a country, Taiwan, and it has all of its wealth invested in buildings and factories in its own country. Well, I can bomb that, right? And if I drop a bomb on your city, the stuff that's in the city, whether it's a garden, a building, a factory, or the people, all that human capital or physical capital, that's impaired. But on the other hand, if I showed you a city and I said, they have $100 billion worth of Bitcoin, but it's not in the city. There's an interesting game theory situation. If you have $1 billion and it's in your pocket and I have a gun to your head, I can just shoot you and take the $1 billion. And the cost of the bullet is a few pennies. So it costs me a nickel to take the $1 billion. But if I have a gun to your head and you have $1 billion of Bitcoin and I shoot you, I'm getting none of it. So when you're in a confrontational situation and someone has portable digital capital, there's an incentive to negotiate. By the way, and if they have physical capital, there's an incentive to violence. It's cheaper to take the physical capital than negotiate, but it's cheaper and more rational to negotiate for the digital capital. And of course, the other point is, if you have digital capital, you'll probably never be in that situation because, you could just pick up and leave with your capital or move the capital somewhere else, or you can use it to influence an ally to help you. I might very well say to Singapore or say to New York, I'll put my capital in New York if you protect me, right? With politically or militarily. So I think that it's very, very wise to invest your capital in cyberspace because it keeps all your options open. It keeps your corporate options open. It keeps your nation state options open. It keeps your individual's options open. It's the hardest thing to impair or to take or seize or steal. It's the easiest thing to actually activate. If there's somebody in New York City that came up with a way to generate yield on $10 billion of Bitcoin, you can zap your $10 billion of Bitcoin to them in 1 hour and leave it with them, and they will pay you $1 billion a year. And then if they ever stop, you can just take it back. And, you can't zap your $10 billion semiconductor facility easily. You can't zap your $10 billion of land or your building. You can't send $10 billion worth of human capital. So this is digital capital. This is high speed, high frequency, and also it's long lived. There's no reason why it won't last hundreds of years. Your building won't. Your semiconductor fab facility won't. Your people won't. So if you're looking for the perfect form of economic energy, it's digital capital. Digital capital is immortal, indestructible, immutable, and it's virtual and programmable. So if you're looking for the best investment of the 21st century, there is no better investment than Bitcoin.